Imagine walking into your favorite coffee shop and it's packed. Every table is taken, the line is out the door, and the cashier is barely keeping up. Now, what if I told you that right there, amid the espresso machines and morning rush, you might have just discovered your next big investment? Sounds too simple? Well, that's exactly what Peter Lynch, one of history's most successful investors, believes. And today, we're diving deep into his book, One Up on Wall Street, to uncover how you can use everyday observations to beat Wall Street at its own game.
Welcome, investors and future financial wizards, to our channel Sumit Sphere. Let's deep dive. Whether you're a seasoned market player or just dipping your toes into investing, this book breakdown will equip you with practical strategies straight from the legendary Peter Lynch. Buckle up, because by the end of this, you'll see stocks and your daily life through a whole new lens.
The main premise, beating Wall Street with common sense. Lynch's core philosophy is simple yet revolutionary. You don't need to be a Wall Street analyst to find great stocks. In fact, you might have an edge over professionals just by observing trends in your daily life. The advantage of everyday investors. Lynch argues that dumb money, individual investors, isn't so dumb after all. Unlike institutional investors who face bureaucratic hurdles and slow decision-making, you can spot investment opportunities early. Remember our coffee shop example? By the time Wall Street analysts catch on, the stock price might have already soared. Why wait for the Merrill Lynch restaurant expert to recommend Dunkin' Donuts when you've already seen 8 new franchises open in your area? Spotting the next Tenbagger. A Tenbagger, a stock that increases tenfold in value, is the holy grail of investing. Lynch insists that many Tenbaggers are hiding in plain sight. Think of brands that are expanding rapidly or products everyone around you seems to love. Actually, there are numerous Tenbaggers in companies you'll recognize: Dunkin' Donuts, Walmart, Toys R Us, Stop and Shop, and Subaru. Doing your own research, the key to winning. Investing isn't about chasing tips or jumping on hyped-up stocks. It's about understanding the business. Lynch encourages visiting stores, testing products, and keeping an eye on real-world trends. During a lifetime of buying cars or cameras, you develop a sense of what's good and what's bad, what sells and what doesn't. Understanding a company's story. Before you buy a stock, can you explain in 2 minutes why it's a great investment? If not, you probably don't understand it well enough. Lynch believes in crafting a simple, clear investment thesis. Before buying a stock, I like to be able to give a 2-minute monologue that covers why I'm interested in it, what has to happen for it to succeed, and what could go wrong. The 6 categories of stocks. Lynch classifies stocks into 6 types, each requiring different strategies. Slow growers, mature companies with modest growth, for example utilities. Stalwarts, large, stable companies offering steady returns, for example Coca-Cola. Fast growers, rapidly expanding businesses, for example the Gap in its early days. Cyclicals, companies tied to economic cycles, for example Ford Airlines. Turnarounds, struggling companies with potential for a comeback, for example Chrysler in the 1980s. Asset plays, businesses with hidden value, such as undervalued real estate holdings. Avoiding the trap of whisper stocks. We've all heard of them: hot stock tips from friends, social media hype, or market whispers. Lynch warns against these emotionally appealing but fundamentally weak investments. Whisper stocks have a hypnotic effect, but usually the sizzle is so delectable that you forget to notice there's no stake. Key financial metrics every investor should know. Lynch simplifies finance by focusing on a few essential metrics. Market capitalization, a company's total value in the stock market. P/E ratio, price to earnings, a key valuation measure to assess whether a stock is over or undervalued. Debt to equity ratio, a measure of financial stability. Think long-term, the power of patience. Lynch warns against the temptation of short-term trading. Instead, he advocates for a long-term perspective, allowing good investments time to grow. It takes remarkable patience to hold on to a stock in a company that excites you, but which everybody else seems to ignore. A watched stock never boils. Other investment nuggets from Lynch. Look for asset plays and niche businesses. Companies with hidden value or little competition can be gold mines. Pay attention to spin-offs. These often lead to undervalued investment opportunities. Buybacks and dividends matter. Companies buying back stock or increasing dividends show confidence in their future. The mirror test. Before investing, ask yourself, do I own a home? Do I need the money soon? Do I have the temperament to handle market swings? Beware of market noise. Avoid buying stocks just because everyone else is. If a hot stock tip is spreading at a cocktail party, it's probably too late. So, the next time you notice a packed restaurant, a brand that keeps showing up in conversations, or a product everyone seems to be raving about, don't just brush it off. You might just be staring at your next Tenbagger. Peter Lynch, One Up on Wall Street, isn't just a book. It's an investment philosophy that teaches us to see the world differently. Remember, the stock market isn't just for the pros. It's for you, the keen observer, the everyday consumer, the curious mind. The next great stock pick? It might already be in your shopping cart. Now go forth and invest wisely. YouTube channel's name is Sumit. Don't forget to like, subscribe, and stay tuned for more insightful content.